Welcome to today's Explainer. We are diving into a rigorous, step-by-step masterclass analyzing Shopify's stock, which is currently sitting at $145.85. As an investment analyst, my goal today is to help you cut through the noise. We're going to use raw source data to figure out the true intrinsic value of this e-commerce giant, and we'll do it by applying the legendary frameworks of Warren Buffett, Peter Lynch, Benjamin Graham, alongside some modern discounted cash flow modeling. Now listen to this momentum. Right after their Q2 2026 earnings release, Shopify's president Harley Finkelstein called it a monster quarter. And he's not exaggerating. We aren't just looking at some static, mature company here. We're analyzing a business that just notched its fifth straight quarter of greater than 30% growth across every major financial metric. But the big question is, does the current stock price actually justify this structural advantage?
Here is our roadmap for today's Explainer. We'll start with a company snapshot, move through the Buffett, Lynch, and Graham lenses, look at DCF valuation models, and finally wrap up with our synthesis and final verdict. All right, let's jump right into Section 1, the company snapshot, looking at some surface-level metrics for Q2 2026. Looking at these core figures pulled straight from the source data, we are dealing with a massive $189 billion enterprise. And what immediately jumps off the screen? That steep 115 price-to-earnings multiple. Whoa, right? But before you write it off as totally overvalued, just look at those bottom two rows. They're pumping out 34% revenue growth and 32% gross merchandise volume growth. The market is clearly pricing in this relentless hypergrowth. And you can see here, this compounding growth is just relentless across the board. Whether it's subscription solutions, merchant solutions, gross profit, or operating income, we're seeing jumps of over 30%. Operating income alone soared 68% year over year. They're driving incredible operating leverage, expanding their margins, and showing absolute financial discipline while they scale. Moving on to Section 2, let's look at this through the Buffett lens, analyzing economic moats and owner earnings. So Shopify has absolutely built an undisputed infrastructure moat. Marketplace Pulse data confirms they now power 14% of all U.S. e-commerce. And get this, their global GMV is an astonishing 66% as large as Amazon's entire third-party marketplace. But here's the catch for Buffett. While the business quality and management consistency easily passes test, that 115 PE ratio completely clashes with his absolute need for a margin of safety. However, Buff loves cash generation. And this number is just beautiful. $654 million. That's Shopify's Q2 2026 free cash flow, which functions as our proxy for Buffett's beloved owner earnings. Not only did it jump from $422 million the previous year, but it represents an incredibly impressive 18% free cash flow margin. This is exactly the kind of cash generation machine Buffett looks for. So, what's the Oracle of Omaha's final verdict? Well, he'd likely admire the underlying business, especially given they recently announced a $3 billion share buyback. But at $145.85, the margin of safety just isn't there. He would absolutely wait for a market pullback, likely holding out for a target price closer to the $80 to $100 range before he'd even think about deploying capital. Next up, Section 3, the Lynch lens, where we focus on growth categories and the PEG ratio. Shopify fits perfectly into Peter Lynch's fast grower category. The balance sheet is an absolute fortress. Pulling directly from their Q2 financials, they've got roughly $1.6 billion in cash and $3.3 billion in marketable securities, totaling nearly $4.9 billion. Assuming standard tech institutional ownership, they're operating from a position of absolute power. Plus, management is innovating rapidly, expanding B2B by 76%, tripling AI-driven orders, and launching new tools like Shopify Magic and Sidekick. But Lynch's ultimate equalizer is the PEG ratio, right? You divide the PE by the growth rate. A PEG of 1 is considered fair value. By dividing Shopify's 115 PE by its stellar 34% growth rate, we get a PEG ratio of 3.38. Now, while Lynch loves fast growers, a ratio this heavy means you are paying a massive premium today for growth that is still years down the line. Is it worth it? The Lynch verdict comes in as a solid hold. If you already own it, the underlying fundamentals, big enterprise wins like Canada Goose and Balmain, and that fortress balance sheet give you every reason to hold on. But initiating a brand new position at a 3.38 PEG ratio, that carries some pretty significant valuation risk. All right, let's pivot to Section 4, the Graham lens, running it through the defensive investor checklist. Now, Benjamin Graham's defensive investor checklist is notoriously brutal for tech companies. While Shopify easily clears the hurdles for adequate size and earning stability, it hits an absolute brick wall on the back half of the checklist. There's zero dividend record, and the price to earnings and price to book multiples are miles above Graham's strict conservative thresholds. When we actually run Graham's legendary intrinsic value formula, things get pretty stark. So taking the square root of 22.5 times the earnings per share times the book value per share, assuming a book value per share of roughly $10.46 based on their total equity and an annualized EPS of around $1.68, this rigid formula yields an intrinsic value of just under $20. So, would Benjamin Graham buy Shopify at $145.85? Absolutely not. The stock is trading more than 7 times higher than his calculated intrinsic value. For a strict historical value investor, this offers literally zero margin of safety. It's a clear sell or avoid in his book. Now, let's fast forward to Section 5, DCF Valuation Models, Exploring Modern Wall Street Mechanics. This is where we project future cash flows and discount them back to today. Based on the ticker guided valuation, we're modeling a 20% compound annual growth rate for revenue, which is honestly conservative given they just posted 34%. We factor in 17.1% operating margins, a 64.9x exit multiple, and discount it all back using our assumed weighted average cost of capital. And wow, here is where the narrative flips completely. Using those exact inputs, the DCF model calculates an implied target price of $176. That suggests an implied upside of over 42% over the next 2.5 years. What looks wildly overvalued to Benjamin Graham looks like a highly attractive compounder to a modern DCF model. To cross-check this, let's look at a quick comparable company analysis. Amazon is trading at roughly a 31x PE with 16.6% revenue growth. Shopify is commanding a massive 115x PE, but its revenue growth is 34%. That is more than double Amazon's growth. Wall Street happily pays a premium for growth, and Shopify is absolutely delivering it. Bring it all together, we reach Section 6, Synthesis and Final Verdict, the Guru Gauntlet results. Our synthesis matrix reveals a really fascinating polarized split. The traditional value frameworks of Buffett and Graham urge extreme caution, focusing heavily on current multiples and demanding a steep drop in price to create any sort of margin of safety. Peter Lynch respects the hypergrowth, but holds off because of the high PEG ratio. Yet the modern DCF model? It is screaming buy, projecting massive upside fueled by expanding free cash flows and dominant market share. So ultimately, the takeaway for this explainer is crystal clear. Shopify is an undeniably world-class business, operating as the absolute backbone of modern e-commerce. They are gobbling up market share, generating immense free cash flow, and proving their pricing power. Your decision at $145.85 really comes down to this one question. Does your personal philosophy demand the safety of yesterday's value, or are you willing to pay a premium today to own the compounding engine of tomorrow's commerce? Choose your lens carefully.